Hey there, investors. Welcome back to another exciting update on the financial front. Big news just dropped on the inflation front, and it's something we've all been eagerly waiting for. The Consumer Price Index, the main gauge of U.S. inflation, cooled down in February, bringing a sigh of relief to many. It came in at 2.8% year over year, which is a significant drop. That's down from 3% in January, marking a positive trend. This is a big deal. It indicates that the measures taken to control inflation might be starting to pay off. It means the Fed's rate hikes might be working, which is a crucial development for the economy. But is it enough to get those rate cuts rolling? That's the million-dollar question. Let's break it down. This February CPI number is crucial for several reasons. First, it gives us a glimpse into the health of the U.S. economy, which has been under a lot of stress lately. It helps us understand whether the economy is stabilizing or if we need to brace for more turbulence. Inflation is like a fever. A little bit is normal, but too much can be dangerous and lead to severe economic consequences. Just like a fever, if inflation gets too high, it can overheat the economy, causing all sorts of problems. The Fed has been trying to bring that fever down by raising interest rates, a strategy that has been both praised and criticized. They've been raising interest rates like crazy, hoping to cool down the overheated economy. This CPI report gives us a hint about whether their medicine is working, and so far the signs are encouraging. So, buckle up because we're about to dive deep into the CPI numbers and what they mean for the future. We'll look at what's driving inflation from consumer spending to global supply chain issues, and we'll see what it all means for your money, your investments, and your financial future. Stay tuned. Alright, let's dissect this CPI report like a frog in biology class. The Consumer Price Index, or CPI, is a critical measure that helps us understand the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services. It's like a thermometer for the economy, giving us a sense of how hot or cold things are getting in terms of inflation. The headline CPI number is 2.8%. This figure represents the overall inflation rate, capturing the average price change for all items in the basket. It's a broad measure that includes everything from groceries to medical care, and it's the number that often makes the headlines. That's the big one everyone's talking about. When you hear news reports about inflation, this is usually the number they're referring to. It's a key indicator of economic health and can influence everything from interest rates to wage negotiations. But there's another important number, core CPI. Unlike the headline CPI, core CPI excludes certain items that can be very volatile, specifically food and energy prices. These prices can fluctuate wildly due to factors like weather events or geopolitical tensions, so core CPI gives us a clearer picture of underlying inflation trends. This one strips out volatile food and energy prices. By removing these elements, core CPI aims to provide a more stable and consistent measure of inflation, which can be particularly useful for policymakers and economists who are trying to understand long-term trends. Core CPI came in at 3.1%. This is slightly higher than the headline number, indicating that while food and energy prices might be stabilizing, other areas are still experiencing price increases. Still a bit sticky, but the lowest we've seen in almost 4 years. This suggests that while inflation is still a concern, there are signs that it might be starting to ease. However, it's important to keep an eye on these numbers over the coming months to see if this trend continues. What's driving these numbers? Shelter costs are still a pain point. Housing is a significant component of the CPI, and rising rents and home prices can have a big impact on the overall inflation rate. They rose 0.3% for the month. While this might not seem like a huge increase, it adds up over time and can put a strain on household budgets, especially for those who are already struggling to make ends meet. That's the smallest annual increase since December 2021, but it's still more than what most folks are getting in their paychecks. Wage growth has been relatively stagnant, so even small increases in shelter costs can feel like a big hit to the wallet. On a brighter note, gasoline prices dropped 1% for the month. This is good news for drivers and can help ease some of the financial pressure caused by other rising costs. Thank goodness for small favors, right? Lower gas prices can also have a ripple effect, reducing transportation costs for goods and potentially leading to lower prices in other areas. We also saw some relief in airline fares, which plunged 4% for the month. This could be due to a variety of factors, including lower fuel costs and increased competition among airlines. But hold your horses before you book that tropical getaway. While lower airline fares are a welcome change, other travel-related costs might still be high, so it's worth doing some research before making any big plans. Egg prices are still scrambled, up a whopping 10.4% for the month. This is a significant increase and can be attributed to supply chain issues and other factors affecting the poultry industry. Blame it on the avian flu. This outbreak has led to a reduction in the supply of eggs, driving up prices and making it more expensive for consumers to enjoy their morning omelets. Used cars, apparel, and beef prices also ticked up. These increases can be due to a variety of factors including supply chain disruptions, increased demand, and higher production costs. See, it's not all sunshine and rainbows. While there are some positive signs, there are still plenty of challenges to navigate. It's important to stay informed and be prepared for potential changes in the economic landscape. So how did the stock market react to this mixed bag of inflation news? It was a roller coaster. Stocks initially jumped for joy, then took a nosedive. The Dow Jones Industrial Average flirted with gains before ending the day down. Talk about volatility. The bond market wasn't too impressed either. Treasury yields, which move opposite to bond prices, rose after the CPI report. This suggests some investors are worried about inflation staying stickier than a marshmallow in a kid's hair. Meanwhile, the US dollar flexed its muscles, advancing against other currencies. This market reaction shows just how uncertain things are right now. Investors are trying to figure out if the Fed will keep raising rates or hit the pause button. It's a real nail-biter. Section 4, the economy's tightrope walk: growth versus inflation. The big question on everyone's mind is this: can the economy achieve a soft landing? That means slowing down inflation without crashing the economy into a recession. Right now, it's a tightrope walk. Wages are growing faster than inflation, which is good news for workers, but it also puts pressure on businesses to raise prices, and that could keep inflation hotter for longer. The Atlanta Fed's GDP Now tracker, which gives us a real-time estimate of economic growth, is pointing to a possible decline in the first quarter of 2025. Yikes! That would be the first negative quarter in 3 years. The economy is sending mixed signals. It's like trying to read tea leaves at the bottom of a very murky cup. Section 5. The tariff wildcard. Will inflation roar back? Hold on to your hats, folks, because there's a wildcard in this inflation game: tariffs. Tariffs, essentially taxes on imports, can have a profound impact on the economy. When tariffs are imposed, the cost of imported goods rises, and this increase is often passed on to consumers in the form of higher prices. This can lead to inflation, as the overall price level in the economy increases. But that's not all. Tariffs can also disrupt supply chains, leading to shortages of certain goods, which can further drive up prices. Remember those pesky tariffs on Chinese goods that former President Trump slapped on? These tariffs were part of a broader trade war aimed at reducing the trade deficit and encouraging domestic production. However, the unintended consequence has been higher prices for consumers and businesses that rely on imported goods. The tariffs have affected a wide range of products, from electronics to clothing to machinery. Well, some of them are still in effect. Despite changes in administration, many of these tariffs have remained in place, continuing to exert upward pressure on prices. The Biden administration has been reviewing these tariffs, but any changes are likely to be gradual and may not provide immediate relief. And guess what? They could make inflation worse. As businesses face higher costs for imported goods, they may pass these costs on to consumers, leading to higher prices for everyday items. This is particularly concerning in an environment where inflation is already a significant issue. Higher prices for goods and services can erode purchasing power and reduce consumer spending, which can have a negative impact on economic growth. Experts are worried that tariffs will push up prices on everything from cars to groceries. The auto industry, for example, relies heavily on imported parts, and tariffs can increase the cost of production, leading to higher prices for consumers. Similarly, tariffs on agricultural products can lead to higher food prices, affecting household budgets and potentially leading to increased food insecurity. That could show up in the CPI numbers as soon as next month. The Consumer Price Index, CPI, is a key measure of inflation, tracking changes in the prices of a basket of goods and services over time. An increase in the CPI indicates that prices are rising, which can be a sign of inflation. If tariffs continue to push up prices, we could see a significant impact on the CPI in the coming months. Some even predict that headline CPI could hit 3.2% by the third quarter of 2025 because of these tariffs. This would represent a significant increase from current levels and could have wide-ranging implications for the economy. Higher inflation can lead to higher interest rates, as the Federal Reserve may take action to cool down the economy and prevent runaway inflation. Ouch! Tariffs are like throwing fuel on the inflation fire. The combination of higher prices and potential supply chain disruptions can create a perfect storm for inflation. Businesses may struggle to absorb the higher costs, leading to reduced profitability and potential job losses. Consumers, on the other hand, may find their budgets stretched thin as they face higher prices for essential goods and services. The Fed needs to tread carefully here. The Federal Reserve plays a crucial role in managing inflation through its monetary policy tools such as interest rates and asset purchases. If inflation continues to rise, the Fed may need to raise interest rates to cool down the economy. However, this is a delicate balancing act, as raising rates too quickly or too aggressively could risk tipping the economy into a recession. They don't want to raise rates too aggressively and risk a recession. A recession could lead to higher unemployment and reduced economic activity, which would be detrimental to the overall economy. On the other hand, if the Fed is too cautious and allows inflation to get out of control, it could erode purchasing power and lead to long-term economic instability. But they also don't want to let inflation get out of control. The challenge for the Fed is to find the right balance between supporting economic growth and keeping inflation in check. This requires careful monitoring of economic data and a willingness to adjust policy as needed. The coming months will be critical in determining the path of inflation and the appropriate response from the Fed. Talk about a tough spot. The interplay between tariffs, inflation, and monetary policy creates a complex and challenging environment for policymakers. As we navigate these uncertain times, it's important to stay informed and understand the potential impacts on the economy and our daily lives. Will inflation roar back? Only time will tell, but one thing is certain: the stakes are high, and the decisions made in the coming months will have lasting consequences. Section 6. Fed on the hot seat, to cut or not to cut. The Federal Reserve is caught between a rock and a hard place. They've been raising interest rates to fight inflation. But now, with inflation cooling down, and the economy showing signs of slowing, the pressure is on to cut rates. The market is betting that the Fed will start cutting rates as early as June 2025. Some even think they could cut rates by as much as 0.75 percentage points by the end of the year. But the Fed is sending mixed signals. They're saying they're going to be data dependent. That's Fed speak, for we're going to wait and see how things play out before we make a move. The Fed's next move is anyone's guess.